Well, good afternoon, everyone, and welcome to this Pitcher Partners webinar. My name is Craig Whatman. I'm a partner in the tax advisory group within Pitcher Partners, and I will be presenting to you today on JobKeeper 2.0, as it's colloquially known, and also the 10% decline in turnover certificates. Just by way of housekeeping, the Q&A function has been disabled for this webinar, so you won't be able to ask questions during the webinar itself. However, if you do have any questions arising out of the presentation, please feel free to contact either your regular Pitcher Partners contact or one of the GST experts who are listed towards the end of this presentation. So we'll get straight into it. This is what I'd like to cover in the next hour or so. Firstly, just to give you an overview of the JobKeeper extension rules, or JobKeeper 2.0. Then an overview of the rules in relation to the 10% decline in turnover certificates under the Fair Work Act. Following on from that, we'll move into calculating GST turnover and decline in turnover for the purposes of both JobKeeper 2.0 and the 10% decline in turnover certificates. Then have a look at turnover in terms of what that means in relation to your business activity statement reporting and the BASs that are lodged. And finally, just some key action items coming out of the presentation that you can take forward. So the rules in relation to the JobKeeper 2.0 decline and turnover test come out of a legislative instrument that you will see referred to on the bottom of the slide. It's one of the instruments that's got the long names following the coronavirus economic response package. But if you'd like to have a further look at that, that is the legislative instrument that I will be referring to when we come to talk about the decline and turnover test and the new rules that have been made for JobKeeper 2.0 purposes. So we'll start off with an overview of the JobKeeper extension or JobKeeper 2.0 rules. So just in terms of the time period, you're hopefully aware by now that JobKeeper 1.0 is coming to an end this Sunday, the 27th of September, and we then move forward into JobKeeper 2.0, of which there are two extension periods. The first period runs from the 28th of September until the 3rd of January next year, so that's 7 additional fortnights. And the second extension period runs from the 4th of January until the 28th of March next year, which is an additional 6 fortnights. So the new JobKeeper rules prescribe that eligibility in terms of the decline and turnover test must be met for both the original decline and turnover test and the new decline and turnover test. Now that all sounds a bit confusing, but what it effectively means in practice is that employers will be able to test the same period moving forward in respect of the extension of the JobKeeper scheme. So for example, if you're seeking to come into the JobKeeper scheme or continue being in the JobKeeper scheme from the 28th of September onwards, then you will be testing the September quarter as the test period for the decline and turnover test. And that quarter applies under both the original decline and turnover test as well as the new decline and turnover test. So you will be conducting a test on the same period, which effectively means that if you pass that test, you will have met both tests that are prescribed under the legislation. The same applies for the second extension period, which looks at the December quarter. That quarter has been prescribed as being a relevant period for both the original decline and turnover test and the new actual decline and turnover test. So you don't have to do two separate tests. Once you succeed in respect of the relevant quarter, you will pass both tests. So these are the fortnights that will apply under both extension periods, just so you're aware of them. The first one being the fortnight that ends on the 11th of October 2020. So that is the first JobKeeper fortnight under JobKeeper 2.0, going right through to the last fortnight, which will end on the 28th of March next year. The importance of these fortnights obviously is in respect of the JobKeeper wage condition. So we'll come to the new JobKeeper payment rates, but as with JobKeeper 1.0, it is important that if you're seeking to remain eligible for JobKeeper fortnights in respect of eligible employees moving forwards, that you have met the wage condition in respect of those employees by the end of each of these fortnights as stated. If you haven't done that and don't otherwise get discretion in terms of an extension from the tax office, then you won't be eligible to receive payments, JobKeeper payments in respect of those employees. So just having a look at the JobKeeper payment rates under the JobKeeper extension and the changes in those rates. So hopefully, again, you're aware by now that there will be a change in the payment rates moving forward under JobKeeper 2.0. So for the first extension period that goes up until the 3rd of January next year, there is two rates, the higher rate being $1,200 per fortnight per employee, and the lower rate being $750 per fortnight per employee. Then from the 4th of January until the 28th of March, under the second extension period, the rates decrease further, with the higher rate being $1,000 per fortnight per employee, and the lower rate being $650 per fortnight per employee. The distinction between those rates is worked out according to a reference period. So to qualify for the higher rate, the relevant employee must have worked at least 80 hours in the relevant reference period, which is either a period of 28 days prior to March, or a period of 28 days prior to the 1st of July. So there is testing that will be required to determine whether your employees, should you qualify for the JobKeeper extension payments, whether those employees will be on the higher rate or the lower rate moving forwards. And there will be a requirement to make the appropriate notifications to the tax office in respect of each employee to ensure that they are on the correct rate. So moving on to the decline in turnover testing, in terms of the relevant decline in turnover thresholds, they are not changing from JobKeeper 1.0. So the thresholds that apply under JobKeeper 2.0 are the same as the thresholds that are applied under JobKeeper 1.0. So in respect of an ACNC registered charity, excluding universities and schools, the relevant threshold is a decline in turnover of at least 15%. For entities that have an aggregated turnover of more than $1 billion, the relevant threshold is a decline in turnover of at least 50%. And for all other entities, the relevant threshold is a decline in turnover of at least 30%. What has changed is the testing period, and we'll come to the specific periods in a moment, but effectively the test moving forward will be a test that's done on a quarterly basis by comparing the turnover in relevant quarters. It will no longer be possible to test on the basis of monthly turnover, which was one of the options that was available under JobKeeper 1.0. So for JobKeeper 2.0, the test must be done on a quarterly basis, regardless of whether the relevant entity lodges their BAS on a monthly or quarterly basis. So even if you lodge monthly, you will still be required to test effectively 3 months worth of turnover for the relevant test period. So what has changed between 1.0 and 2.0? The first important change is that the decline in turnover test is now based solely on current GST turnover rather than projected GST turnover. So you may recall with JobKeeper 1.0 that back in March, April, etc., as you were determining whether the relevant employer entity would be eligible for JobKeeper 1.0, you would have been looking at your turnover potentially on a projected basis for the months of March, April, May, etc., or the quarter ended 30 June. So those calculations at the time could well have required you to do projections of your turnover for the relevant month or the relevant quarter, taking into account the fact that those periods hadn't yet finished. The rules in respect of JobKeeper 2.0 move to an actual turnover test or current GST turnover. So you will be required to look at periods that have completed and the actual turnover that has been derived in those periods, rather than being able to do a projection in respect of any period that is not yet complete. So the decline in turnover test will need to be satisfied for two key turnover periods in respect of both the extension period 1 and the extension period 2. And it is a quarter-on-quarter test, as I said a moment ago. So you will be required to compare your turnover in the relevant quarter of 2020 against your turnover in the corresponding quarter of 2019. As I said, there is no ability under JobKeeper 2.0 to do the decline in turnover test on a monthly basis. Even if you lodge your BAS monthly, it must be for a quarter. So you can't test the month of July 2020 versus July 19, or August 2020 versus August 19, etc. It must be the quarter ended 30 September 2020 or the quarter ended 31 December 2020. So which quarter is relevant depends on which extension period you are looking at. So to qualify for JobKeeper payments on an ongoing basis from the 28th of September through to the 3rd of January next year. So whether you're an employer that was within JobKeeper 1.0 or you're an employer that didn't qualify for 1.0 but is seeking to qualify for 2.0, if you're seeking payments from the 28th of September through to the 3rd of January, you will be required to do your decline and turnover test looking at the quarter ended 30 September 2020 and comparing the turnover in that quarter to the turnover in the quarter ended 30 September 2019. So at the moment, obviously, we're not yet at 30 September, so it's not technically possible to actually determine absolutely whether you will be qualifying for JobKeeper payments under the first extension period from next Monday onwards, which is putting everybody under a little bit of pressure because obviously employers are keen to understand whether they will be entitled to either continue receiving JobKeeper payments in respect of the fortnights starting next Monday onwards, or coming into the system as a new employer that is qualifying for JobKeeper 2.0. Whilst it's possible to look at the turnover test on projected figures, technically you can't qualify until you've determined your actual turnover for the completed quarter ended 30 September. So you won't be able to sign off absolutely that you do qualify until you have your actual figures for that quarter. Once we get to the fortnights commencing from the 4th of January next year onwards through to the end of the extended JobKeeper 2.0 scheme on the 28th of March, you will then need to do a retest based on your turnover for the quarter ended 31 December 2020 and comparing that to your turnover for the equivalent quarter in 2019. So even if you do qualify for payments from next Monday onwards, for the fortnights that commence next Monday onwards, in respect of turnover for the September quarter, there is a requirement to retest again in respect of the JobKeeper fortnights that can commence from the 4th of January next year, which will mean that during the holiday period for a lot of people, there will be some work to do in respect of JobKeeper if you are seeking to continue receiving JobKeeper payments in the period from January to March next year. There will be a need to actually determine your turnover for the quarter ended 31 December and compare that to the turnover in the December quarter of 2019. So some work to do over the holiday period there. So that's the relevant periods that will need to be tested. Before we get into the actual decline in turnover test rules and the changes that have been made, I just wanted to also give you an overview of the 10% decline in turnover certificates. Now, some of you may not be familiar with these, but they do form an important part of the decline in turnover rules, and also particularly relevant under the Fair Work Act in respect of JobKeeper related directions that have been and will continue to be made to be given by some employers to their employees under the JobKeeper extension period. So effectively, what the 10% decline in turnover certificate process relates to is the extension of the JobKeeper related provisions in the Fair Work Act, which give employers the ability to issue directions to their employees in respect of things such as reduced hours or being stood down, in respect of altering the employee's place of work or duties, etc. So they are an important tool for those employers that wish to keep issuing those directions under the Fair Work Act. And what has been implemented as part of the Fair Work Act now is a requirement for employers that wish to either continue issuing those directions or start issuing them for the first time, to hold what is referred to as a 10% decline in turnover certificate. So from the 28th of September, being next Monday, for employers who wish to continue issuing directions to employees under the Fair Work Act, and where those employers do not qualify for JobKeeper 2.0, in order to be able to continue issuing those directions, those employers will need to satisfy a 10% decline in turnover test. So a different threshold for this purpose from the other thresholds that I referred to a moment ago, and also hold a certificate that has been issued by an eligible financial service provider, or in respect of small businesses have made a statutory declaration for the relevant quarter, and I'll come to the quarters in a moment. So any existing JobKeeper enabling directions or agreements under the Fair Work Act that are already in place will end on this Sunday, the 27th of September. And employers, as I said, who need to reissue or make new directions and agreements must satisfy the 10% decline in turnover test, and unless they are a small employer, must obtain a 10% decline in turnover certificate from an eligible financial service provider in order to be able to continue issuing those directions to their employees. Fortunately for us, the 10% decline in turnover test under the Fair Work Act provisions uses the same GST turnover concepts as JobKeeper 2.0. So the rules have been linked together, and although the threshold is different, being 10% for this purpose, the means of testing that threshold and the relevant rules that apply are the same for both purposes. So a certificate is required where you have previously participated in the JobKeeper scheme So you were eligible for JobKeeper 1.0 payments, but you're no longer eligible for JobKeeper 2.0 payments, for example, because you no longer meet the decline in turnover test under JobKeeper 2.0. So those employers are referred to as legacy employers, and they can only continue issuing the Fair Work Act JobKeeper directions if they've, from the 28th of September onwards, if they obtain a 10% decline in turnover certificate. So a 10% decline in turnover certificate is not required for employers that are receiving JobKeeper payments under JobKeeper 2.0 in respect of the first or second extension period. So those employers that have qualified or continue to qualify for JobKeeper payments under the extension periods can continue to issue the relevant directions to their employees, some of which are listed here on this slide. They can continue to issue those directions without holding a 10% decline in turnover certificate. So just to emphasize that the 10% decline in turnover certificate is relevant for those employers that were within JobKeeper 1.0, so were receiving JobKeeper payments for a JobKeeper fortnight prior to the that ended prior to the 28th of September, but won't qualify to receive JobKeeper payments for the fortnights from 28th of September onwards, and who wish to continue issuing these directions to their employees. So how does the 10% decline in turnover certificate testing work? It applies in respect of designated quarters that are applicable to specified times. So they are the designated quarters, and specified times are defined terms within the relevant provisions of the Fair Work Act. And there are 3 specified times for which an employer requires a certificate in order to issue directions to employees, and it will be necessary to obtain a separate certificate in respect of each of these specified times that are referred to on this slide here. So from next Monday onwards, for an employer who wishes to continue issuing relevant directions to their employees, they will need to obtain a certificate that relates to the specified time in the left-hand column of the slide, which says before October 2020. So for the period from 28 September to 27 October, the relevant quarter that needs to be tested for the purposes of the 10% decline in turnover test is the quarter ended 30 June 2020. So you'll note there's an important difference between this process in relation to the 10% certificates versus the JobKeeper 2.0 rules. So for the JobKeeper 2.0 rules and the extension of that scheme from 28 September onwards, the first relevant quarter that will need to be tested is the quarter ended 30 September 2020, whereas for the 10% certificate rules, the first relevant quarter that needs to be tested is the quarter ended 30 June 2020. So what that means, and it's a little bit confusing, but what it could possibly mean is that if you were an employer that qualified for JobKeeper 1.0 payments, you satisfied the, let's say, the 30% decline in turnover threshold, you've now determined, or you will determine post 30 September, that you won't satisfy the 30% decline in turnover threshold for the quarter ended 30 September. But you then say, well, I need to obtain a 10% decline in turnover certificate in order to issue JobKeeper related directions to my employees. Then for that purpose, you're going to need to test the quarter ended 30 June 2020, and it's quite possible that your decline in turnover for the quarter ended 30 June could actually still exceed 30%. But that's not relevant for JobKeeper 2.0 purposes. For JobKeeper 2.0 purposes, you have to test the quarter ended 30 September. So it's a bit odd in terms of the difference in the quarters there, but effectively the rules around the 10% decline in turnover certificates have been lined up with the BAS reporting periods, which is why we have this first specified time being up until 28th of October, and that is in respect of the quarter ended 30 June, and really that lines up with the rules around the lodgement of the BAS for the relevant quarter. So the second specified time period is the period from 28 October to 27 February next year. And in order to continue issuing relevant directions to employees, the employer will need to then retest their turnover in terms of the 10% decline test on the basis of the quarter ended 30 September 2020. And then finally, from 28th of February next year through to the end of the JobKeeper period being, the extended JobKeeper period being 28 March next year, the relevant quarter that will need to be tested is the quarter ended 31 December 2020. So 3 separate specified time periods that apply in 3 separate designated quarters that must be tested for the purposes of the 10% decline in turnover test and for the purposes of obtaining a 10% decline in turnover certificate. And as I said, they will need to be tested separately, and you will need to obtain a separate certificate if you wish to continue issuing the relevant directions all the way through until the end of March next year. As I said, a certificate must be obtained from an eligible financial service provider, which is a defined term under the Fair Work Act. It includes tax and BAS agents. Otherwise, if you're a qualifying small employer, you can make your own statutory declaration. But if you're not, and it's a very limited category, you will need to approach an eligible financial service provider and give them relevant information to enable them to test your 10% decline in turnover for the purpose of determining whether they can issue you with a 10% decline in turnover certificate. So that's an overview of both the JobKeeper 2.0 rules and the 10% decline in turnover rules. As I said, fortunately, the rules regarding GST turnover, or the amended rules, have been lined up between those two for those two purposes. So the same rules that I'm about to talk to apply for the purpose of determining both your JobKeeper 2.0 decline in turnover and your 10% decline in turnover for the purposes of the Fair Work Act certificates. So moving on to what is your GST turnover for those purposes and how do you calculate it. So the new rules that have been set out in the legislative instrument that I referred to at the beginning of this presentation are based on what's referred to as an actual decline in turnover test. And for these purposes, GST turnover includes, as it did for JobKeeper 1.0, the value of all taxable and GST-free supplies that have been made by the relevant employer entity during the relevant quarter. However, in a significant departure from JobKeeper 1.0, there will now only be one method available to test your decline in turnover for the relevant periods, and that is known as the GST attribution method. So for those of you who were within JobKeeper 1.0 or are familiar with those rules, you may recall that the decline in turnover rules and the methods that were available under JobKeeper 1.0 did give some flexibility in terms of the method that could be chosen. So effectively the legislative position was that you had to work off the time of supply rules, which is a very confusing set of rules, which was really only relevant for the purposes of transition to GST back in late 1999 and early 2000 when GST came into effect. But what the ATO did eventually publish under JobKeeper 1.0 was a ruling which effectively said that you could have a choice. So acknowledging that a strict time of supply basis was difficult and would be difficult for a number of employers to manage, the ATO set out two other methods that would be available to employers if they were implied in good faith. And those two methods were the accounting accruals method, so working off your financial statements from an accruals accounting perspective, or the GST attribution method, which is the method that you use for reporting in your business activity statements. So effectively, there are three methods that could have been used under JobKeeper 1.0 for testing your turnover in the relevant periods. Two of those methods have now disappeared completely. So the legislative instrument, which is the law now effectively for JobKeeper 2.0, states that you must use the relevant GST attribution or BAS reporting method that applies to you as a GST entity. So I'll come to the differences that gives rise to shortly, but what it effectively means, number one, is that the concept of projected GST turnover, which was relevant for JobKeeper 1.0, is now effectively no longer relevant for JobKeeper 2.0. And the main impact of that is that certain sales of capital assets or other supplies that are made in reducing the size or the scale of a business must now be included in your GST turnover for JobKeeper 2.0 and 10% decline in turnover purposes. Those disposals of capital assets and other related supplies were under the law able to be excluded from your projected GST turnover for JobKeeper 1.0. But now that projected GST turnover is no longer a relevant concept, they can no longer be excluded, and any revenue that you've received from those supplies must now be included in your JobKeeper 2.0 testing. So what does that mean practically? It may mean that it could be difficult for some businesses to satisfy the actual decline in turnover test for JobKeeper 2.0 purposes, even if they were eligible for JobKeeper 1.0, possibly because they have made a sale of a capital asset or another supply of a significant nature in the relevant turnover test period, which could mean that they won't satisfy the 30% threshold or the other relevant decline in turnover threshold that applies to them as an employer. And I'll come to an example on that at the moment, but it's just an important concept that you all need to be aware of up front, which is that capital asset disposals must be included as part of the testing for JobKeeper 2.0 and the 10% decline in turnover testing moving forward. So how do you calculate your turnover? And what is the value of supplies? So the value of a supply is a defined concept for GST purposes in the GST Act, and it equals the GST exclusive consideration received in relation to the supply. So when you're using the basic test, for example, the basic JobKeeper decline in turnover test, the value of the supplies that have been made during the relevant quarter should, theoretically at least, align with what has been reported on your business activity statement for that quarter, or in the 3 months of that quarter if you need to report and lodge your BAS on a monthly basis. Now, I've said theoretically, and that's and we'll come to this a bit later on, but the reason I say theoretically is that in my experience, it's reasonably common for the figures that are reported at G1, label G1 of the BAS, not to be entirely representative of what needs to be included within GST turnover for these purposes. And that's because a number of registered entities do include things within their BAS that technically should not be included. They might not have any impact on the net amount of GST that needs to be reported for the relevant period, but they may not be part of GST turnover for these purposes, or they may have left things off the BAS that are GST turnover for these purposes, but they don't think they need to report on their BAS. So we'll come to some examples of that a bit later on. But the starting point here for JobKeeper 2.0 and 10% decline in turnover certificate purposes is effectively your BAS, and it's labels G1 and 1A of the BAS. So theoretically, all things being equal, you should be able to start at label G1 at that figure, deduct the GST amount at label 1A, and the difference should be the GST exclusive value of the supplies that you have made for the relevant period. So as I said before, there is now only one method available under the amended JobKeeper rules that can be used for calculating your decline in turnover in the relevant periods, and that is the GST attribution method. What is the GST attribution method? It's effectively the method that you're required to use for business activity statement reporting purposes. So the method that you use for determining the period in which you pay GST on supplies and claim GST on acquisitions. So there's two possible methods under GST attribution, and they are the cash basis accounting method and the non-cash basis or accruals accounting method. So for a non-cash basis or accruals accounting taxpayer, the GST payable on their taxable supplies must be attributed to the earlier tax period in which they receive any consideration for that supply, or they issue an invoice for that supply. So whichever of those occurs first, then that is the period to which the relevant GST in respect of that taxable supply must be attributed and must be reported in that business activities statement. On the other hand, if you're a cash basis accounting taxpayer, the GST payable on a taxable supply that they make is attributed as and when they receive consideration for that supply. So for example, if they receive consideration by way of installments, then they would attribute those installments one by one as they receive the cash, as they receive those installments. So they don't have to report the full amount of GST on that supply up front because they are a cash basis GST taxpayer, and therefore they can report it on a cash receipts basis. So those are the two reporting methods for GST purposes, and they now link directly into the relevant rules for the decline in turnover test and allocating supplies to periods for JobKeeper 2.0 and for the 10% decline in turnover certificates. So the legislative instrument that I referred to at the commencement of this presentation now has prescribed rules which require relevant employers who are seeking to test their decline in turnover moving forwards, require them to allocate the relevant supplies on the basis of these rules. So if you are a GST registered taxpayer which has not changed your GST accounting basis between the relevant periods in 2019 and 2020, you must use the GST accounting basis on which you are registered for the purposes of your decline in turnover test. So if you're an accruals basis taxpayer that prepares and lodges your business activity statements on an accruals basis, and that's been the way that you've reported GST for the whole time during 2019 and 2020, then that is the method that you must use for for determining the period to which the relevant supplies relate, and for the purposes of the decline and turnover test under JobKeeper 2.0. So you don't have a choice, effectively. If you're registered for GST on a non-cash or accruals basis, you must use the non-cash accruals basis for determining your decline in turnover moving forwards. On the other hand, if you're a business with less than $10 million turnover who would qualify for the cash basis reporting, and you have been registered for GST and reporting your GST on a cash basis, then you must calculate your decline in turnover moving forwards on a cash basis. Under JobKeeper 1.0, those cash basis employers effectively had a choice whether to use cash basis or accruals basis for testing their decline in turnover. That's changed under JobKeeper 2.0. So that choice is no longer available, and if you're registered on a cash basis, you must use a cash basis. Alternatively, if you're an entity that's not registered for GST, which it is still possible for non-GST registered entities to qualify for JobKeeper payments. Those are the only entities that effectively have a choice to use either a cash or accruals basis to allocate their supplies to the relevant periods, the relevant quarters, but they must use the same method for both the turnover test period in 2020 and the relevant comparison period in 2019. So you can't swap and change between cash and accruals. You must use either the cash basis for both quarters in both years, or the accruals basis for both quarters in both years. So now that we are working off a GST attribution basis for JobKeeper 2.0 and the 10% decline in turnover certificate testing, it is important to understand effectively what can be included within the concept of consideration, because as I've just said, the attribution rules for an accruals basis taxpayer at least look to the period in which any part of the consideration has been received or an invoice has been issued, whichever occurs first. So if you've received any part of the consideration for a relevant supply and you're registered for GST on an accruals basis, then you are required under the GST attribution rules and the legislation to account for the full amount of GST on that supply at the time you receive that consideration. So consideration is defined in the Act as any payment, act, or forbearance in connection with, in response to, or for the inducement of a supply of anything, which is a bit of a mouthful, but effectively what it means is that it includes any monetary or non-monetary consideration. So it can be non-monetary, doesn't have to be cash or in monetary form. And an important point to be aware of, particularly where your relevant employer entity may be part of a corporate group, including a GST group, which needs to be accounted for. Members of a GST group must account for their supplies separately, including their supplies to other members of the GST group. So for those related entities, often consideration can be in the form of book or journal entries that are made between the entities. So there may be no invoice that changes hands, there may be no cash that changes hands, but there may be a journal entry that has been made between those two entities. And the ATO has a public determination, GSTD 2004/4, which effectively says that if you make a journal entry which effectively means that you've paid for or deemed to have paid for a relevant supply that's been made to you by way of an entry in a loan account, for example, then at the date that that entry is made, that is the date that you will be deemed to have received consideration for GST purposes. So that's important in the concept, in the context of things like year-end adjustments. And so if you're a corporate group which does adjustments after 30 June in respect of management fees or other service type fee arrangements between related entities, then those adjustments may be made by way of a journal entry between the related entities that occurs in the quarter ended 30 September 2020. And as far as the ATO is concerned, based on that public ruling, that if you make that journal entry in the quarter between 1 July and 30 September 2020, then you will be deemed to have provided consideration for the relevant supply from the other entity. So that other entity will therefore have received consideration and therefore have turnover, if you like, for JobKeeper 2.0 purposes that must be attributed to that quarter. So just something to be aware of, particularly between related parties. Aside from the ordinary rules regarding attribution around invoices and consideration, there are also a number of special rules just to be aware of in the GST legislation that can alter the time at which attribution needs to be made for GST purposes and therefore for JobKeeper turnover purposes. So there's a number of determinations that have been issued by the tax office, and a few of them are listed here. I won't go into them in detail, but just to make you aware of some of them in case they are relevant to your business, to your employer. So there's a special determination that has been issued where the total consideration for a supply is not known. So for example, where you've made a supply for consideration which has two components, one of which is fixed and is therefore known up front, but a second component which may be contingent upon certain hurdles being met or events happening at some point in the future. So effectively what that determination says is that you need to account for the GST on the fixed component of the consideration at the time that that's known under the ordinary rules, and then you account for the GST on the contingent component at the point when you become aware of that contingent component and the fact that it will form part of the total consideration for the supply. So where the relevant hurdle is met and you then become entitled to the additional part of the price, for example, then at that point you would then be required to attribute for GST purposes the remaining part of the GST on that component of the consideration. There's also a determination for supplies made through agents where you have a principal agent relationship and the supply is made by an agent in circumstances where the principal may not yet be aware that that supply has been made. So effectively delaying attribution of the GST on that supply until the principal becomes aware that their agent has made that supply on their behalf. There's a determination in respect of contracts that are subject to statutory cooling off periods or preconditions, which again defers the relevant attribution timing until a later point once those conditions have been satisfied, and also a particular determination effectively in relation to construction contracts or other contracts that provide for retention of some part of the total price as a retention amount, and the determination again defers the attribution of that part of the consideration that has been retained until it's clear that it will form part of the total consideration that can be retained by the supplier. So in addition to the special determinations, there are some further exceptions to the standard GST attribution rule in the legislation. Most common one is in respect of supplies and acquisitions that are made for a period or on a progressive basis, and where the consideration provided for those supplies is also on the same basis. So it's provided progressively, effectively. So those supplies are effectively treated as separate supplies or acquisitions as each part of the consideration becomes payable, and the GST on those supplies is attributed to each tax period over which the progressive or periodic supply is made. So That rule's really only relevant for non-cash or accruals basis taxpayers. It's not relevant for cash basis taxpayers because, as I said previously, those cash basis taxpayers only account for GST as they receive the relevant cash amounts. So just to give you an example of that type of attribution rule. So we have a commercial lease that commenced in July 2020 for a 2-year term. There's monthly lease payments under the lease. So for GST purposes, if you're the lessor and trying to work out your turnover for the relevant period, then Division 156 of the GST Act would allow the GST that is payable on that lease to be attributed across the entire lease period. So effectively, each monthly lease payment is deemed to be consideration for a separate supply that's been made by you as the lessor, and that each monthly lease payment would therefore be attributable to your monthly BAS if you're a monthly lodger, or the relevant quarter if you're a quarterly lodger, across the entire 2-year term. So you don't have to account for GST on the full 2 years worth of rent up front. It can be spread over the 2-year term of the lease. So just going back to a point I made a few slides back regarding the difference between current GST turnover and projected GST turnover. So as I said, for JobKeeper 2.0 purposes, and also for the purposes of the 10% decline in turnover certificates, we are only looking at current GST turnover. Projected GST turnover is no longer relevant, and what that means is that disposals of capital assets must be included within the turnover for the relevant period. So just to give you an example of the difference that could potentially make in terms of eligibility for ongoing JobKeeper payments, we've got United Co here, which is an employer that has an aggregated turnover of less than 1 billion and satisfies the requirements to use 30% as the relevant decline in turnover threshold that it needs to meet for JobKeeper purposes. So United Co has taxable supplies in the relevant period of $1.5 million. It's also disposed of a capital asset in the turnover test period. So let's, in this case for JobKeeper 2.0, let's say it's the September quarter. The quarter ended 30 September 2020 would be the turnover test period for the first extension JobKeeper. And it has disposed of a capital asset, sold a capital asset in that period for which it has received $500,000. So in terms of United Co's decline in turnover test, if it was doing that test under JobKeeper 1.0, then its turnover in the turnover test period, being the quarter ended 30 September, under JobKeeper 1.0 rules, would have been $1.5 million. And the reason for that is because under JobKeeper 1.0 and using the concept of projected GST turnover, United Co would have been able to ignore or exclude that sale of the capital asset from its turnover. So the $500,000 could have been excluded, and its total turnover for the test period would have been $1.5 million. Compare that to JobKeeper 2.0 and testing under the amended rules, which, as I said, is based on current GST turnover. That sale of the capital asset must be included as part of United Co's turnover for the quarter ended 30 September 2020. So it will now have total turnover for that period of $2 million as opposed to $1.5 million. So when it compares its turnover for the test period to the comparison period, the quarter ended 30 September 2019, and assuming that the turnover in that quarter was $2.5 million. You can see the difference that it makes in terms of the end result. So for JobKeeper 1.0 purposes, doing the relevant calculation, United Co would have suffered a decline in turnover of 40%, therefore meeting the 30% threshold and being eligible for JobKeeper 1.0 payments. Whereas under the amended JobKeeper 2.0 rules, its decline in turnover is now reduced to 20%, and it therefore fails the decline in turnover test because its decline is less than 30%, meaning that it is not eligible for JobKeeper 2.0 payments. So this rule can work both ways depending on when you've disposed of assets. It could be a different story, for example, if you've made that same disposal in the relevant comparison period in 2019, made a substantial sale of a capital asset in that period, which would beef up your turnover for that period compared to the turnover test period in 2020, and that would be the reverse result. But for some employers who perhaps have needed to dispose of their capital assets in the COVID period in order to give themselves some cash flow and keep afloat during the COVID period, then this could potentially impact their ongoing eligibility for JobKeeper payments from the 28th of September onwards. So how do you test your decline in turnover under JobKeeper 2.0 or the 10% certificates? Once again, as with 1.0, there are two effective tests. One being the basic test, which compares the relevant test quarter in 2020 with the corresponding quarter in 2019. And then there is the alternative test or a series of alternative tests which compare the relevant period in 2020 with a different period in 2019 due to the fact that the rules determine that there is no suitable, that the comparable quarter, for example, may not have been a suitable quarter due to the circumstances of that employer in 2019. So you may be aware that there were a series of alternative tests that were available under JobKeeper 1.0 for situations such as where a business has an irregular turnover, so lumpy turnover, or in circumstances where their turnover had substantially increased in a period leading up to March this year when the COVID pandemic first commenced. As at the date this presentation was prepared, the ATO had not yet released its amended rules regarding the alternative tests. Hot off the press, I understand that they may have in fact been released this morning, so I haven't had a chance to review them as yet and therefore won't be speaking to them. But we do expect the same or very similar tests to be available as alternative tests for JobKeeper 2.0 purposes, but there will be some changes to the rules around those tests that you'll need to make yourself familiar with, and no doubt we will be preparing a bulletin which will be coming out shortly in relation to those tests, and I understand there may in fact as well be a separate webinar that will be conducted next week in relation to those alternative tests. So watch out for that if you're interested in the alternative tests and that's relevant to your business. So getting to then the concept of GST turnover and how that relates to the business activity statements that you've lodged. As we've seen, if we are seeking to come within the first JobKeeper extension period from 28 September to 3 January, then we will be doing an actual decline in turnover test based on the September 2020 quarter versus the September 2019 quarter, assuming that you're under the basic test. And the starting point for that, obviously, then is the BAS that has been lodged either for the quarter ended 30 September 20 and 19, or the months of July, August, and September if you're a monthly lodger. But that is only the starting point, and it needs to be, I guess, made clear that the figures that are in the lodge BAS, although they are a good starting point, and they are the figures that the tax office will be using when it conducts JobKeeper reviews and decline and turnover eligibility reviews for relevant taxpayers. They won't just accept, the ATO won't just accept those figures at face value. So it's important that you do have a look at the figures that have been reported in your lodge business activity statements, and then make any adjustments that may be required to those figures to come up with your correct GST turnover under the JobKeeper rules. And as part of that, Pitcher Partners has produced a GST turnover checklist, which is available on our website. If you'd like to go to our website after this webinar, there is a checklist there that goes through a whole series of different questions that you can run through yourself to determine whether any adjustments need to be made to the figures that you have reported in your lodged BAS for the purpose of coming up with the correct current GST turnover for JobKeeper 2.0 and 10% decline in turnover purposes. So feel free to have a look at that in your own time. So part of that checklist, here's some of the issues that are on that checklist that you need to consider when you're looking at your lodge BAS and determining whether you need to adjust the figures. And I'll just run through these quickly so you're aware of them. So if you're in the property development sale industry and you've made supplies of apartments, etc., under the margin scheme, then it may be that if you've lodged your BAS correctly and prepared it correctly, the amount that you've reported at G1 for each sale would only be the margin that on which GST is payable. However, for GST turnover purposes, the full sales price for that sale of the apartment is actually your turnover. So it's not just the margin on which GST is payable, although that is how you determine your GST liability on that sale. That is not your complete turnover for GST turnover and JobKeeper purposes. So you would need to adjust the figures to include the full amount of the sales price in respect of the relevant sales. As we've seen before, GST-free supplies are relevant and need to be included within your GST turnover. So if you haven't reported those in your BAS, which is a reasonably common circumstance where taxpayers just leave GST-free supplies out of their BAS because they don't have any GST impact, those supplies will need to be included within your turnover. On the other hand, if you've made any input tax supplies, such as supplies of residential rental or financial supplies, which are input taxed, if those have been reported in your BAS, which they could well have been if you've been following the ATO's guidance on how to prepare your BAS, then they will need to be excluded from your GST turnover, so deducted from G1 to get to you the correct GST turnover result. Out of scope income refers to things like dividends and trust distributions, which do not constitute consideration for any supply that's been made. They're actually not part of GST turnover for these purposes. So if they're appearing in your BAS, they would need to be reversed out, as well as supplies of things like private assets, which are not part of any enterprise that you carried on. Supplies that you've made as agent of another party. So when you're acting as an agent and you sell something as agent of someone else, being your principal, then effectively that supply is made by the principal and is not made by you. So if you've reported the sales income in respect of that supply in your BAS when you're an agent, then you will need to change that for GST turnover purposes, and all you should be reporting is any commission or other fee that you've received in your role as agent. The majority of insurance settlements are not part of GST turnover and will need to be reversed out if they've been included within your business activity statement. On the other hand, where you've made barter transactions, so you've entered into a transaction with someone where there may be no cash that's changed hands, but you've agreed to give them something in return for getting something yourself, then that could well be a taxable supply that would need to be included within your GST turnover, as well as supplies that you've made to your associates. So if you haven't included in your BAS supplies that you've made to your associates, then they could well be taxable supplies that would need to be included within your GST turnover. In certain circumstances, the GST Act could deem the value of that supply to be at market value if you haven't accounted for market value. GST groups, importantly, so one of the JobKeeper specific adjustments is to basically disband the GST group, if you like, such that if the relevant employer is a member of the GST group, then they need to take into account the value of supplies that they have made to other members of that GST group. So even though a GST group for normal GST reporting purposes is treated as one entity, and you ignore any supplies made between the members of the GST group, for JobKeeper 2.0 purposes, and in fact JobKeeper 1.0 purposes as well, those supplies from that employer to other members of the GST group must be included within the employer's turnover. And then there's an issue about whether you've actually got the correct entity for registered for GST purposes, and that's particularly important where you're part of a partnership or in a trust relationship. So just to give an example of that, if we look at these two business companies here that have a 50-50 interest in a commercial rental property and operate a joint bank account between themselves in respect of the income and expenses for that property, and have the same managing agent that manages that property on their behalf. If those two business companies are separately registered for GST, it's quite possible that that may be an incorrect registration, on the basis that if that enterprise is being conducted jointly and they're deriving income jointly, then they could well be a partnership for GST purposes, for tax and GST purposes, and may well have been required to actually register as a partnership for GST purposes. So if those entities are actually determining their decline in turnover for JobKeeper purposes on their own account, they may well be doing that wrong, on the basis that in fact it should have been a partnership that is doing the decline in turnover test. So just something to be aware of if you are in joint ventures, partnerships, etc. with other parties. The other main one, the main area that we commonly see, is where there's a trust relationship and the trustee company, for example, is the entity that's been registered for GST purposes, whereas it's only acting as trustee, and in fact it should have been the trust that is registered for GST purposes, the underlying trust. So just in terms of adjustments, this is an important one where you may need to adjust the figures that have been reported in your BAS. So there is a concept in GST called an adjustment event, which can cancel a supply that's been made previously or change the consideration for that supply. Now, the issue for JobKeeper purposes and also for the purposes of the 10% decline in turnover certificates is that those adjustments in the main will actually need to be reversed out of your turnover for the relevant quarter. So if, for example, you're looking at testing your turnover for the quarter ended 30 September, and within that quarter, you have issued a credit note to one of your customers, which gives them a credit in respect of a taxable or GST-free supply that you've made to them in a previous quarter, then that credit note will constitute an adjustment event, which will give rise to an adjustment to the relevant supply that must be accounted for in your business activity statement for the quarter ended 30 September. However, for JobKeeper purposes, because that credit note adjusts the value of a supply that's been made in a previous quarter, let's say the quarter ended 30 June, then that adjustment has to actually be excluded from your turnover for JobKeeper purposes. So even though you've correctly included that adjustment note in your BAS and reported it in your BAS for the quarter ended 30 September, for the purposes of calculating your JobKeeper 2.0 decline in turnover and or your 10% certificate, you will need to reverse that adjustment out of your BAS. The same rule applies for bad debt purposes. So if you've issued any, if you've written off any bad debts in the September quarter, but those bad debts or that bad debt relates to a supply that's been made in a previous quarter, then effectively that bad debt adjustment would need to be reversed out of your turnover for the quarter ended 30 September. So sometimes depending on whether those types of credit notes or bad debt adjustments are material, and depending on how close you are to the line in terms of the relevant decline in turnover threshold, then they could make the difference between qualifying or not qualifying for JobKeeper 2.0 or the 10% decline in turnover certificates. So you just need to be aware that there is a special rule that applies for these purposes to adjustments, and it applies where you're adjusting a supply that's been made in a previous quarter. If you're adjusting a supply that's been made in the same quarter, so you issue a credit note in September for a supply that's been made in July, then you don't need to reverse that out because that's all happening in the same quarter. It's in respect of a supply that's been made within that same quarter. But on the other hand, if you issue that credit note in September and it relates to a supply that you've made in June, then you would need to reverse out that adjustment for JobKeeper purposes. As with JobKeeper 1.0, there will be an ongoing administrative requirement in terms of reporting to the tax office. So you will be required to continue, or if you're coming in for the first time, to start reporting your current GST turnover for the reporting month that's just finished, as well as your estimated or projected GST turnover for the following month. And that report must be provided to the tax office within, we believe, 7 days. It might possibly be 14 days of the end of each calendar month. So it is important to ensure that what is reported is accurate, particularly in respect of your current or actual GST turnover for the previous month, because you will be aware, hopefully, that the ATO is using that data for the purposes of determining which taxpayers it wishes to conduct JobKeeper reviews. And we are now seeing JobKeeper 1.0 reviews being conducted by the tax office. We've got a number of those going on within the Pitcher Partners client base, and I'm sure across the taxpayers in Australia as well. So please be aware that you could be subject to a review either within the period that JobKeeper continues up until March next year, or even after that period. So it's important that you, as always, retain the relevant documentation to prove that you've met the JobKeeper eligibility requirements. There you go. Eligibility requirements, including in respect of the decline in turnover test. So retain the documentation, make sure you're ready if the ATO does come and knock on the door, and make sure what you're reporting to the ATO after the end of each month is accurate. So why do we have these new rules? Why have we moved to a sole GST attribution method as the only method that's available for determining decline in turnover under JobKeeper 2.0? Our understanding from our consultations with Treasury and the ATO on this issue is that it's really driven by compliance. So the ATO has effectively determined that for the purposes of its ongoing compliance of the JobKeeper scheme and doing targeted reviews of entities that have enrolled in the JobKeeper scheme and which are receiving JobKeeper payments, it believes that the GST attribution method is the one that makes the most sense from a compliance perspective, because it can then start, as I said, with the figures that you have reported in your lodged business activity statements for the relevant quarter or the relevant months that make up that quarter, and work backwards from there. Whereas under the other two methods, the accounting accruals method and the actual time of supply method, it was far more difficult for the ATO to actually ask for and receive, acceptable information from taxpayers that it could then review for JobKeeper eligibility purposes. So that's our understanding of the reason why we've moved to GST attribution as being the main method. What it does mean is that it may, make it more difficult for some businesses to remain eligible for JobKeeper 2.0 if they were eligible for JobKeeper 1.0, or even for new entrants coming into JobKeeper 2.0. It could work the other way as well. It could make it easier for some businesses to qualify on an ongoing basis where they may not have previously qualified under a strict time of supply method. In terms of the relevant periods, obviously under JobKeeper 1.0, once you were in from the beginning, then you remained eligible for JobKeeper payments all the way through until the end of September. There was no requirement under 1.0 to retest your eligibility at any point during that 6 months. Whereas 2.0, now you've got two parts of the extension that I've referred to previously, being the part up until the 3rd of January and the period from the 4th of January until the 28th of March, and separate tests that need to be done for both of those periods, testing the relevant quarters. So there is some sort of increased complexity, if you like, around the testing, both for JobKeeper 2.0 being for the multiple periods and also for the 10% decline in turnover certificates. If you will need those, you've got 3 potential testing points and periods that will need to be conducted in order to obtain a 10% decline in turnover certificate right through until the 28th of March. So that really could result in an increase in compliance costs for a number of employers. So finally, and we're coming towards the end here, I've almost taken up the hour and a half. Thank you for bearing with me. So the key action items are, moving forward out of this webinar that we recommend you think about really are, number one, where do you sit from a JobKeeper 2.0 eligibility point of view, and particularly in respect of the decline in turnover test that is required in respect of JobKeeper payments for fortnights commencing from 28 September onwards. Are you likely to meet the decline in turnover test, looking at your figures for September quarter 20 versus September quarter 19? Or alternatively, are you going to drop below the relevant decline threshold, if that's 30% or 50% or 15%? Are you going to drop below that threshold when you're looking at the September quarter? And if so, if you're in JobKeeper 1.0 but won't qualify for 2.0, do you have a need to continue issuing JobKeeper related Fair Work Act directions to your employees on an ongoing basis? And if you do, you then need to reasonably quickly start thinking about the 10% decline in turnover certificate requirements and the testing that needs to be done for that, for the purpose of approaching an eligible financial service provider to do that testing and to obtain that certificate, which you will need to hold from next Monday if you wish to continue issuing JobKeeper related directions to your employees from that date onwards. So those are really the issues that we believe you should focus on coming out of this webinar, and for JobKeeper 2.0 and 10% decline in turnover purposes. As I said, if you do have any questions coming out of the presentation, please feel free to contact either your regular Pitcher Partners person who you deal with, or alternatively feel free to contact either myself or one of my team who are listed on this slide. Would be happy to answer any questions that you do have. But that brings us to the end of today's presentation. Appreciate your time. Thank you very much for staying with me for almost the whole hour and a half. best of luck with your ongoing JobKeeper 2.0 assessments and also your 10% decline in turnover certificate assessments. I hope you and your families are keeping well. Thank you for joining us, and we look forward to seeing you again.